Welcome to today's session on the fundamental principles of accounting. My goal is to simplify the key rules that shape financial reporting and show you why mastering these concepts is essential in any business environment. If you're interested in connecting or want to learn more after the video, be sure to check out my LinkedIn profile, linked below. Let's jump in by laying out today's agenda. Before we dive deep, here's a roadmap of what we'll cover. We'll begin with the foundational principles of accounting, then explore double-entry bookkeeping, the month-end closing process, and account reconciliation. We'll review both GAAP and IFRS standards, discuss asset and liability management, and learn how to build an effective chart of accounts. We'll wrap up by examining accruals, deferrals, depreciation, and finish with a summary of key takeaways. Each of these topics builds upon the last for a comprehensive understanding, so let's get started with the basics. Accounting principles form the backbone of reliable financial reporting. They ensure that financial statements are consistent, comparable, and accurate, fundamental qualities for decision-making. Whether it's the matching principle or proper use of accruals, every concept guides how transactions are recorded and what gets disclosed. Sticking to recognized principles builds trust within organizations and with regulators and investors. Next, let's explore how these principles actively create trust and transparency in financial practices. Establishing trust in accounting relies on three pillars. First, transparency empowers leaders and investors to truly understand business performance and risk. Transparency isn't just about opening the books. It requires using ethical judgment, especially when things get complicated. Second, the main objective is to present a true and fair view of a company's finances. High-quality disclosure, reliability, and comparability are all essential to building confidence among stakeholders. Third, accounting's key pillars like matching principle, materiality, and consistency guide how we record and interpret financial events. Matching ensures expenses align with the revenues they help generate. Materiality keeps us focused on what matters most, and consistency allows for fair benchmarking over time. Now, let's examine the engine that powers accurate record-keeping, double-entry bookkeeping. Double-entry bookkeeping is the gold standard for maintaining accurate records. Here's how it works. Every transaction touches at least two accounts, creating a natural system for tracking and detecting errors. We start by journalizing, or recording, each financial event with both a debit and a credit to ensure the books always balance. Next, we post these entries to ledger accounts, aggregating data and preparing for reconciliation. After posting, we balance the books. That means checking that debits equal credits, reinforcing the equation of assets equaling liabilities plus equity. Lastly, frequent error checking helps us catch and fix discrepancies fast, safeguarding the integrity of our records. With double entry mastered, let's see how it supports an organized close at the end of each period. A smooth month-end close is crucial for accurate and timely reports. It begins by preparing the trial balance, where you verify that all transactions are correctly reflected. Any anomalies must be identified and addressed before moving forward. Next is posting adjusting entries, including accruals, deferrals, and corrections, to ensure the accounts reflect reality. Finally, you review financial statements and use handy dashboards or checklists to confirm completeness and accuracy for stakeholders. Having a strong closing process sets you up for the next essential step: reconciliation. A robust reconciliation process is key for compliance and building trust. There are three main elements: controls, automation, and verification. Controls mean documenting unresolved entries and escalating them as needed. Automated systems can streamline reconciliation with regular schedules and clear procedures for managing adjustments. Verification involves comparing the ledger to external statements and resolving any discrepancies. By matching internal and external records, you prevent errors and support reliable financial reporting. With reconciliations in place, it's vital to understand the impact of global accounting standards on your business. Let's look at the two major frameworks: GAAP and IFRS. GAAP is used mainly in the US and is rules-based and highly prescriptive, while IFRS is broadly adopted worldwide and is principles-based, offering more flexibility. GAAP sticks to historic cost and often limits fair value, whereas IFRS prefers fair value assessments. GAAP requires extensive and detailed disclosures. IFRS focuses on principles-led reporting. When it comes to leases, GAAP divides them as operating or finance, but IFRS uses a right-of-use model. Transitioning between these standards takes careful mapping and technical judgment, making collaboration across borders essential. Now, let's talk about managing assets and liabilities for healthy financial balance. Effectively managing assets and liabilities ensures liquidity and strengthens your balance sheet. First, capital allocation involves reviewing investments for return, cash flow, and depreciation, as well as optimizing working capital. Second, liability optimization is about monitoring obligations and payment schedules, and reducing financing costs by refinancing debt or negotiating better terms. Finally, risk mitigation means diversifying asset types and using strategies like hedging to deal with interest rate or currency fluctuations. Scenario planning helps anticipate and prepare for financial risks. With your assets and liabilities under control, it's time to discuss how you organize financial data, the chart of accounts. A well-organized chart of accounts is the backbone of transparent financial reporting. System integration with ERP and other accounting tools is crucial, especially after major changes like mergers or launching new business units. Robust controls prevent duplication and ensure accurate mapping across departments. Limiting access rights protects data and supports audit traceability. Group account codes logically, by type and with clear numbering for efficient navigation. Routine reviews keep everything aligned with business growth and regulatory changes. Next, let's clarify some important accounting concepts: accruals, deferrals, and depreciation. Now, let's break down three crucial concepts: accruals, deferrals, and depreciation. Accruals ensure expenses and revenues are recognized in the period they occur, not simply when cash changes hands. This keeps financial statements aligned with economic reality, so you get a clearer view of the business's performance. Deferrals, on the other hand, delay recognition of certain expenses or revenues until later periods, matching costs and benefits to the right timeframes. This helps prevent misleading spikes or gaps in your financial results. Depreciation spreads the cost of tangible assets, like equipment or buildings, over their useful lives. This method not only reflects the gradual value loss, but also enables smarter investment planning by smoothing out large expenses over time. Together, these techniques help create financial statements that accurately portray business operations, helping management and investors make well-informed decisions. Let's wrap up our journey with a summary of major takeaways. Congratulations, by following these core accounting principles and processes, you now have a powerful foundation for financial clarity and control. Remember, continuous skill development is vital. Invest time to learn advanced techniques and always stay up to date on evolving rules and technologies. Automation and analytics can greatly boost efficiency and reliability. Accuracy is essential. Trusted and timely reporting supports strategic, operational, and compliance activities at every level of an organization. As global standards change, keeping your accounting practices current and robust is more important than ever. Thank you for joining me on this overview of fundamental accounting principles. For further learning or questions, don't hesitate to reach out through my LinkedIn. Be sure to subscribe for more expert insights.